This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. Before I get into my guest today, a quick reminder, recently released, the new audiobook of my latest edition of Trend Following, an edition of Trend Following expanded by over 100%. This audiobook, over 34 hours. Go check it out. My guest today is Andrew Lo, professor of finance at the MIT Sloan School of Management. Andrew has a great perspective on many of the subjects near and dear to me. His newest work, Adaptive Markets, Financial Evolution at the Speed of Thought. You must read this book. Look, the efficient market hypothesis, come on, give me a break. You know in your heart of hearts it's not useful. Andrew digs in deep to present an alternative way of thinking. And I got to tell you, this is where we should all be going. I hope you enjoy this conversation with Andrew Lo. So Andrew, the first time I saw your name, I want to say it was in a transcript. It was in a transcript, and I believe it was called the Greenwich Roundtable. All these great hedge fund manager names, Jim Simons, Toby Crable, Ken Tropin, all these guys that are seemingly with their work showing there's a problem with the efficient market hypothesis. And that was where I first saw your name was in those. And those are some great transcripts. I don't even know if they're available, but they're fantastic information in those transcripts. But let me take you back in time a little bit. I know and I've seen you talk about being in an event, the National Bureau of Economic Research, at an event in 1986. And you talk about there, and I'll let you explain too, but you talk about that your results were not accepted so quickly, so to speak. But even go back before 1986. Give me the starting point where you started to think to yourself, there's a problem with one of the most important precepts in finance and the efficient market hypothesis. Give me that foundation and some of those early experiences where you started to question things.
Sure. Well, it was an interesting time because I grew up in the tradition of efficient markets. And as a grad student, I was taught by a number of faculty that really the efficient markets hypothesis was gospel truth. And so I took it to be gospel truth. I certainly didn't have any reason to doubt it. But the thing that got me started down another path was the fact that I enjoy dealing with data and looking at numbers. As part of my research, right after I graduated, I decided to take a test of the efficient markets hypothesis by focusing on the random walk. The idea wasn't to reject the random walk. It was just to come up with an interesting statistical tool. That was my ambition. And together with my co-author, Craig McKinley, we designed this statistical method that used a very specific property of random walks, the idea of a drunkard's walk. Can't predict where a drunk will go. If you apply that to this notion of the stock market following a random walk, it turns out that you can construct a very simple test using ratios of variances. And we thought we had come up with a pretty neat statistical test and wanted to try it out. So we just decided to apply it to the U.S. stock market. We were shocked to learn that according to our test, the stock market did not follow random walks. At first we didn't believe it because, we were taught in grad school that markets were unpredictable because of this notion of efficiency and randomness. And it really took us probably a good 10 years of various kinds of additional tests, refinements, and various kinds of counterfactuals that we had to rule out, that ultimately I came to the very uncomfortable conclusion that the random walk hypothesis was actually false.
What's really interesting about some of your writings is you are pretty open about academia in the sense the competition and how difficult it is to be an outsider to get a view across. When you and Craig first started to have those aha moments, give me a sense of that feeling of looking at each other. I mean, was it one of those kind of things where you're both, young guys and you have this experience, you've done all this work? I mean, what was the emotion in the room? I mean, were you excited? Were you scared? I mean, what were you feeling?
Well, when we first came upon the result, we actually thought we made a programming error. So we had to go back and redo the calculations. And I remember very distinctly that Craig and I each replicated the calculations separately on our own, using our own software, and ultimately coming to the exact same conclusion. So we checked our results quite a few times before we ultimately came to the very uncomfortable conclusion that, the data really doesn't comport with this theory. So I think initially it was really disbelief, and then eventually it became a kind of a grudging acceptance that there's this inconsistency. And then for several years after, we tried to explain it away. We explained it away, we thought, with various kinds of anomalies. And one by one, as we looked at those anomalies, whether it was trading costs or asynchronous trading or various other kinds of, explanations that really had to do with the details of market microstructure, we couldn't explain it away, and eventually came to that conclusion that, in fact, the theory didn't fit. But it was a difficult process for us because, we were really raised in that kind of an environment. I ultimately, had to come to the conclusion that what we were taught wasn't true.
Were there early experiences with other academics or even people on Wall Street where you, we're going to end up going down the path of your newest book, Adaptive Markets, but in the early stages, when you started to talk to people about your work and what you had found, were the reactions, I'm expecting there were some reactions where just go away? I mean, what was the, I saw the note about the MBER event, but speak to me about if anything comes to mind about an early conflict, perhaps.
Well, so certainly when we showed our colleagues the results, before even presenting it in a conference setting, our colleagues thought that we had made an error, and they just didn't buy it. So that's what prompted us to go back and redo our calculations. And then when we presented it at this conference with a number of our peers, they also didn't believe it. We were really, kind of taken aback. That was our very first academic conference, and we hadn't realized that there could be such controversy. We never expected to be part of that controversy. Over time, it became clear that we hadn't made a programming error, and the data really did show that the random walk wasn't consistent with market data. But it took a while to get there. And at that point, once you acknowledge the fact that the data weren't wrong, you had all sorts of uncomfortable questions that you had to deal with in terms of the consequences. And so we spent a fair bit of our early years as assistant professors working out those implications.
And that's the early foundation as we kind of bring it up to current day and your work, Adaptive Markets, and your hypothesis, your theory. Why don't I let you, from a big picture, the 35,000-foot look down? I can see, and I relate to so many things that you write about. They just, you can feel, okay, here's the influence of Daniel Kahneman coming in. Here's where these guys, here's where you have gone down the path to see that the efficient market hypothesis is not accurate. But what I like about the kind of big picture view, and I want you to run with this, is that this is more about, from your perspective, not viewing everything as a well-oiled machine that's just perfect. It's more about biology. It's more about evolution. Why don't I let you give your big picture view to the audience?
Well, economists have this view of the world that is very much driven by the model that physicists have developed. I often say that economists have physics envy because we wish we had 3 laws that explain 99% of all observable phenomenon the way physicists do. In fact, economists can't explain more than 5 or 10% of all observable phenomenon with 99 laws that we come up with on various different occasions. And it's terribly frustrating because we are fundamentally dealing with more difficult problems. I think Richard Feynman, the great physicist, said it best when he said, imagine how much harder physics would be if electrons had feelings. And, clearly we understand that the world is a much more complicated place because of human behavior. The idea behind the adaptive markets hypothesis is really to try to change that worldview, to change the view that economists have gotten used to of using mathematics the way physics uses mathematics. In other words, to try to model mechanistic systems that don't change over time and have these immutable fundamental laws, to a world of biological phenomenon where what we're dealing with are different species that are interacting with each other, and that it's really the laws of evolution, mutation, selection, and ultimately adaptation to various different changes in the environment and to various species that drive market dynamics. So that's really what the adaptive markets hypothesis is. It's just taking the basic principles of evolution and applying them to financial market transactions and dynamics.
It sort of seems intuitive, maybe from the catbird seat of experience now, but it seems intuitive that when you look at some of the behavior, for example, we'll give the audience some color and think of some events going back to 1973, 74. You can think of 1987. You can think of the dot-com bubble. You can think of the Great Recession. None of these events, conform to any kind of precise model. They just look emotional.
I think it is intuitive, but really from the perspective of investment professionals, given your background and your experience, you've seen a lot of these non-stationarities and punctuated equilibrium events where markets can change dramatically over the course of just a few months or a few years, and they look nothing like the kinds of mechanistic explanations that mathematical economists like to use. But people who are steeped in the theory, namely academic economists, they get very wedded to their ideas. And so, part of the process of coming to the adaptive markets hypothesis was a bit of self-examination about how we as economists engage in research and dialogue with each other, the kind of mindset that we all have, and almost the sociology of our field has been part of the process of really understanding how it is that for so long we haven't come to terms with the fact that there are these disparities between our theories and the various different data that are out there.
There's the cross-discipline aspect here, too. If you look at it, you're kind of like, okay, this very bright MIT finance professor, economist, is in the middle of dissecting financial theories, but at the root of that is thinking about things like sustained emotional stress just keeps us human beings from making rational decisions. It's a really cross-discipline to where you've gone in your work. Do you feel like that sometimes? You kind of think to yourself, wow, I'm going in much different directions than perhaps I thought I was going to go when I first started my career.
Absolutely. I certainly had no intention of cutting across these various different disciplines. When I first started out, I was perfectly happy as a card-carrying economist focused on all sorts of phenomenon that you would expect a good financial economist to think about. Derivatives pricing, risk management, investment theory, all of these ideas were really squarely in the domain of financial economics. What ultimately led me to these various different fields was the fact that the data that we were using to try to explain these theories just didn't fit. I wanted to understand why they didn't fit. I wanted to trace the origin of these discrepancies. And I guess as an academic, we're trained to be pretty stubborn in terms of trying to get to the bottom of things. I started by trying to understand the behavioral literature that emerged in the 1980s and 90s by psychologists and behavioral economists. I couldn't make sense of these anomalies because while they developed all of these different anomalies, they didn't explain why they were there or when one anomaly would be appropriate versus another. And so from the behavioral finance literature, I went to the psychology literature to try to see if the answer was there. And the psychologists didn't give any answers. They had many, many different theories that were, in many cases, mutually inconsistent. So then I went from the psychology literature to the neuroscience literature, because after all, behavior is ultimately generated by the brain. And from neuroscience to evolutionary biology and to ecology. And it was really just continuing my search for an understanding of how to reconcile the various different views of financial markets that brought me through all of these various different disciplines.
You know, even though you have put this work together that strikes at the heart of so many financial careers, you don't write in a way where you're not trying to hurt anybody, so to speak. You're trying to get to the truth the best that you can, seeing that there is these inconsistencies clearly exist. I'm just wondering, though, as you've been working on your book for the last couple of years, and it's come out most recently, you must have smiled, I'm guessing, when the Nobel Committee handed out prizes to Fama and Schiller in the same year. That must have caused you to kind of go, wow, they're kind of setting the foundation for, giving me a foundation to push off from. How did you feel about when that was announced?
Well, that's exactly right. I was delighted by that choice, and not just the two, but all three. Having Gene Fama, Bob Schiller, and Lars Hansen win the Nobel Prize, all for their work in finance in the same year, was, I think, absolutely inspired. And I couldn't be more pleased with how the Nobel Prize Committee formulated their choices. And I knew that there was a bit of a sense of humor and kind of an impish, mischievous humor in the Nobel Selection Committee's choices, because in the past, this has happened before, where in certain cases, they would select economists that had diametrically opposing views in the same year, almost to, underscore both the importance and relevance of each of the theories, but the fact that it's still a work in progress and that we don't have all the answers yet. And I think that's exactly what they did when Fama, Schiller, and Hansen won. My interpretation of the three choices was, markets are efficient, except when they're not, and quantitative methods can help us to distinguish between the two. Those exactly are the three choices that they made. And you're right, it does set the stage for trying to reconcile these various different perspectives.
It's like giving carte blanche to say to the academic community, to Wall Street, do you have a way to, as you just mentioned, do you have a way to settle this? What are people thinking? It was almost a challenge issued. There are different reactions of those set of choices. I think that one reaction that I've heard is that, well, this is clearly confirmation that economics is not a science if you can have two people who win the Nobel Prize in the same year saying the opposite things. And so I've heard that on a few occasions, but I think that that's a relatively uninformed view of economics. I think that more and more economists are coming around to my view, which is that it was a very inspired choice because it highlighted both the value of each of these schools of thought, but also the fact that we're not done yet, that there's still some very important kinds of reconciliation that needs to be done among the various different perspectives. Let me take you back in time a little bit as we build out here. We start this conversation with the early 80s, your first presentation, 1986. I would like for you to go back and kind of give me a feeling of how your thoughts were developing when, for example, October of 87 hit, when the dot-com bubble burst, and when the Great Recession happened. Give me an idea of where you were at each one of those events in terms of your thinking and how each one of those events affected you, if not perhaps even just kept giving you more confirmation that you were on the right direction.
It was really the confirmation perspective that I think characterized those phenomena. Efficient markets hypothesis disciples would argue that prices fully reflect all available information. And so you would not expect there to be tremendously large price movements unless there was some kind of external shock. And October 87, nobody could really identify any kind of external shock that caused this massive crash. It wasn't as if there was some outside event or political disaster or a threat of war. It was just really an extraordinary change in the fundamentals of market valuation. That suggests that either the valuations on the previous week were way overinflated and now we're at the correct price, or it would have said that the prices today were clearly irrational and too low relative to what they ought to be last week. But you can't have it both ways. And so that was sort of the beginning of my sense that we really need a different narrative. And what that narrative is was a mystery at the time. It was something that I was groping at. You know, one series of events after another started bringing more and more light onto the particular problem. It was really in 1999 that I think I finally started putting all the pieces together. This was, you know, after LTCM, as well as the 87 crash, as well as a number of events in the market that really called into question, you know, how people behaved. In 1999, I remember a very fateful trip to the zoo, the Washington, D.C., the National Zoo. I read about in the book where, you know, I was visiting the gorilla house because my son was just an absolute fan of gorillas, since one of his favorite books when he was growing up was Good Night Gorilla. At that time, 1999, he was 4 years old. So we went to the Great Ape House, and there was an outdoor exhibit with the gorillas. And I remember very clearly my son standing next to me. We were just beyond the reach of a very, very adorable baby gorilla who was sticking his arms out for some peanuts. My son approached that baby a little too quickly to give him peanuts. The mother gorilla immediately came over and grunted and was, quite threatened by my son's actions. As soon as that mother went to interpose herself between my son and her child, I immediately jumped in and grabbed my son and pulled him away. And at that moment, I realized that my actions and the gorilla's actions were not that different. That we were actually wired in the exact same way, and we reacted instinctively to protect our young. And that got me to thinking that the same kinds of explanations that we propose for animal behavior, that should apply to Homo sapiens as well. We are, after all, another species of animal. We may be more sophisticated, we may have more complex kinds of opportunities to change our behavior, but nonetheless, we share some very important circuitry. So that was sort of the beginning of the adaptive markets hypothesis making itself clear to me, and how it fit in with all of the various different existing theories that we were developing.
Bring yourself up to 2007, because as a professor at MIT with your specialties, summer of 2007 got quite chaotic. And then, of course, coming into the fall 2008, October 2008, give me some perspective, perhaps some feeling about, I mean, again, it could have just been more confirmation that you were on the right path. But did something come out of the Great Recession that added to your perspective even more?
Well, it did. And it actually started in 2005. So in 2005, I wrote an article. Actually, the article was first presented at a conference in October of 2004. It was an article that looked at the notion of systemic risk, the idea that the entire financial system could be at risk. The motivation for that was, of course, what happened several years before, 1998, LTCM, the fact that a hedge fund could create these kinds of shock waves that ultimately threatened the financial stability of the entire financial system was really quite an extraordinary event. And so I spent a fair bit of time studying that leading up to 2004. Well, one of the things that my students and I discovered when we looked at the data on hedge funds is that from a variety of different statistical measures, we were seeing a buildup of leverage and illiquidity in the hedge fund space. And because we saw the impact of hedge funds.
What style were you guys looking at that time? What type of style of hedge fund?
Well, we were looking at all different styles. So the data that we had was from TAS, the hedge fund database, where they provided individual hedge fund returns across various different kinds of strategies. So we actually broke them down by 11 different categories that ran from managed futures and trend following all the way to convertible bond arbitrage, emerging market debt, and so on. And so we looked at each of these different categories. The category that we found the most interesting was fixed income arbitrage. Fixed income arbitrage was the category that was involved in the LTCM debacle. And what we noticed leading up to 2004 was that that particular family of strategies was becoming more popular, was raising more assets, was becoming more and more illiquid using this illiquidity measure that we had come up with a few years before. We had a series of statistical models, factor-based models, to try to understand the risks in the hedge fund industry. And what we were finding, not just in that particular strategy category, but across all the categories, we noticed that assets were growing and the kinds of factor exposures, the commonalities among these hedge fund strategies, they were also growing, and that the correlations among these strategies, which were supposed to be relatively uncorrelated and great sources of diversification, we noticed that actually they were becoming much more highly correlated. All of this going into the end of 2004, and that's when we presented our results at a conference. We pointed out that hedge funds were becoming a much more important source of systemic risk, and that there was a concern of ours that we were going to see a repeat of 1998, but on a much larger scale. And so we first presented it in October of 2004, and the paper we ultimately wrote and circulated caught the attention of a New York Times reporter in September of 2005. In one of the issues, I think it was the Sunday Times, one of the Sundays in September, he actually wrote about our paper, and the last paragraph was that the nightmare scenario that we were looking at was one of the hedge funds blowing up and bringing down one of the broker-dealers that lend to them. When that article came out, we were roundly ridiculed by former students and colleagues on Wall Street because they thought that it would be impossible for a hedge fund collapse to bring down a major bank or broker-dealer. That was in September of 2005. And of course, just a couple of years later was Bear Stearns, which was brought down by their hedge fund strategy, and the same with Lehman Brothers a year later. When the financial crisis hit, we had already been talking about it, and back in October of 2004, and then ultimately May of 2005 was when the first salvo was realized. May of 2005 was when General Motors downgraded their debt. And if you remember that time, that month, a number of convertible bond arbitrage managers all lost money at the same time. So that was one example of the so-called crowded trade phenomenon. And between 2005 and 2008, a series of crowded trades blew up one after the other. And that's basically what we had written about back in October of the previous year.
At that time, you were accessing data from TAS. Did you have access to data, or did you know the full scope of the trading activities inside the then four largest major investment banks?
We did not. In fact, one of the things that we had no clue about was what was going on in subprime mortgages. People had been talking about it, and there were a number of red flags that were being raised by various different pundits, including Bob Schiller and Raghu Rajan. But our focus was really on hedge funds and the data that we had access to. We didn't realize that what we were looking at was just part of a much, much bigger problem, and that the hedge fund industry ended up being the canary in the coal mine they're the first to get hit. So as an early warning sign, the hedge fund industry plays an invaluable role in allowing us to understand what's going on with financial markets. And it wasn't until a year or two later, after all of these various different losses started piling up, that we began to put the pieces together.
Do you ever allow yourself, and I'm not asking for any kind of forecast or anything like that, but when we're at all-time highs, everything is just going swimmingly, there's got to be something in the back of your mind that says, what do I not know?
I think that we are heading towards a major dislocation. And I think part of the reason that you can tell this is the direction we're heading has to do with the combination of volatility in the stock market, the fact that it's near all-time lows if you take a look at an indicator like the VIX. But then when you take a look at various other measures like skewness, kurtosis, the volatility of volatility, these measures are all pointing towards some kind of a major event that may be happening over the course of the next 6 to 12 months. And I think that definitely is something that is worth watching.
What's interesting is you say that too, and I want the audience to keep something in mind, is you're not attempting to say, some of these guys out there on assorted social media and whether, the finance channels making the daily prediction, you're more or less, you're looking at the data, you're saying, here are the extremes that we're seeing, and it's worth paying attention to these particular ratios given past historical situations.
Absolutely. I'm certainly no market pundit. I think Paul Samuelson said it best. He pointed out that economists predicted 5 out of the last 3 recessions. I think we want to be careful about making forecasts, but what gets me concerned and causes me to raise the red flag at this point is the fact that when observed volatility is low, the VIX being, what is observable right now, the implied volatility that market participants are using to price these various different instruments. What that suggests is that there's a complacency that investors have developed. When they feel that risk looks low, they will often start increasing the exposure to market securities and essentially bring their own personal portfolios up to the level of risk that they're comfortable with. If you're comfortable with 10% volatility and the market looks like it's half of that, you might be willing to take double the exposure. When the volatility goes down over time, investors start taking more and more risk, thinking that the risk in the underlying market instruments have gone down. But in fact, that may be a misperception. In fact, the risk may not have changed. It's just that there's a period of lower than average volatility, but it's likely to pop back up at a moment's notice. And I think when that happens, there are going to be some very, very rude awakenings. That's the kind of market disruption that I'm concerned about.
Hey, I would be amiss if I did not follow up. You mentioned Paul Samuelson, an early proponent of the efficient market hypothesis in an early form. That'd be a correct statement?
Absolutely.
And I think what's so interesting about him is he had this view, but then he also kind of had this really cool side gig called Commodities Corporation. And I
Right.
think that's so awesome, right? I mean, he was right there with a theory, trying to figure things out. But when it came to his money, he trusted the traders that he thought made the most sense for his money.
So I asked him about this. I was fortunate enough to be colleagues with him for a few years at MIT before he passed away. He was kind enough to invite me to lunch one day. And I asked him about this. I asked him about the origins of Commodity Corporation. He was very open about it and mentioned that when it first got started, the first year or two, they had used various different academic theories of supply and demand in order to try to make money in pork bellies and other commodities. They basically ended up losing money for the first year or so. And it wasn't until they brought on traders who were using technical analysis to trade that they started becoming profitable. This was a very, very strange situation for Samuelson to be in, because he obviously didn't believe in technical analysis. And yet, his portfolio was doing just fine. So he ultimately, I think, developed a different perspective, which is that there may be microeconomic efficiencies while macroeconomic inefficiencies persist. And so that's how he sort of reconciled these two ideas. But it was something that I don't think he ever fully came to terms with while he was alive.
I love the great line that he has that I found somewhere, that he thought Amos Hofstadter Sr., who died in a traffic accident in the 70s, he thought he was the greatest trader he had ever seen. I thought that was one of the great lines, just one of those things where if people are paying attention to the details, it shows that a lot of your work, I mean, right there, the fact that Samuelson, was an early proponent and involved in Commodities Corporation. Again, that's another foundational jumping off point for your work.
Right.
I want to talk some big picture stuff. People are going to need to go dig in. It's a really interesting read, Adaptive Markets. But I want to talk about big picture here, because the idea of changing the financial culture, how do we make progress? And something that you point out in your work, which I think is really tough for people to accept, is the environment. Speak to when you want to bring people into your world, you want to bring them into the adaptive markets mindset. Speak to environment and the role that it's playing, because it's a really big role.
It is, and I think it's something that economists have not really focused on, and something that I'm hoping to change with the book. The basic idea is actually pretty simple. It goes back to what a biologist or an ecologist would say, and that is that when you start studying a particular ecosystem, you got to understand not only the flora and the fauna, but you have to understand the environment to be able to figure out how all the various different species relate to each other. And sometimes the environment is actually more important than the species that are populating that environment. A case in point is something that the economist / psychologist Herbert Simon proposed years ago. He once observed an ant crawling across a beach. This ant had the most intricate path that took it around puddles of water and across logs and underneath rocks. It seemed like the ant was navigating in an incredibly sophisticated way across an extraordinarily complex terrain. Simon asked the question, how does an ant with very, very little cognitive skills, certainly something that we would take for granted as inconsequential relative to mammals, how does an ant engage in such complicated motion? It finally dawned on him that it's not the ant's motion that's complicated. Rather, the complexity of the path is really a reflection of the environment. The ant may actually have some very simple rules, like if you run into an object, then turn around or go left, and then next time go right. It's really the environment that dictates the complexity of that kind of behavior. And so when we start thinking about individuals engaging in all sorts of very complex behaviors in the stock market, we have to stop and ask, is it something intrinsic about the individual, or is it really the environment that is causing that kind of complex behavior? The example that I give to investors is this notion of investing for stocks in the long run. We all tell investors that they should be long-term investors, that they should hold on to stocks for the long run and not worry about these kind of short-term fluctuations. That may be good advice, but frankly, that's just not credible, because when the market drops by 50%, as it did between 2008 fourth quarter and 2009 first quarter, when you see your 401k turn into a 201k, you are going to react. And the reaction is going to be freaking out. And what that means is that you can't be a long-term investor if you're worried that the short run is going to kill you first. That kind of market environment suggests that the kind of investment strategies that we propose investors follow, they're simply not realistic. They don't take into account the fact that investors are going to react, and that means that the environment is going to have an indelible impact on their long-term wealth accumulation policies.
There's a great line from Buffett where he says, if you can't afford to lose 50% in the markets, you shouldn't be in the markets. And I've been asking people recently, I've been saying to people recently, say, hey, where are you right now? What's your situation? Are you kind of passive index? You basically long only? And I said, can you imagine how you would feel if your current stock holdings, assuming you're in long only, all-time highs, can you imagine how you would feel if you saw a 50% decline or a 60% decline, or even going back to the 1999-2000 time period, a 77% decline in the NASDAQ? I don't know. I really, it's funny, even after March of 2009, it was such a quick kind of 6-month period, and then things got back to rock and roll. I don't know how people would react if all of a sudden the S&P was back at 1999 levels.
Well, I think that how they react is they freak out. And so this freak out factor is really what drives a lot of market dynamics. And the sooner we can start modeling those dynamics more explicitly, the sooner we'll have more realistic theories about how markets move.
Let me follow up real quick on one last thing here. You brought up the environment. I think I'd love to get your comment on this as well too. When people, another way to think about the environment would be, okay, what type of particular return can I expect in a given year? Well, the reality is you really can't make that kind of guess. You just don't know. Mm-hmm. And I think there's something to the idea that if you can take what the environment gives you, and if your headspace is such that you're comfortable with what the environment gives you, you've got a leg up. Whereas the example that I just mentioned, people long all-time highs, if they're not even remotely expecting that the environment could give them something that they're, it's just not in the cards. But it's another way to think about the environment. I think it's a positive way to think about it if you can let yourself go there, and you doing your work, of course.
That's right. I think it's a very important point to change the mindset from thinking that the market is a kind of a machine that cranks out 6% risk premium year in and year out. I think that's a myth that's been perpetrated by both academics and certain practitioners. Those of us who are in the markets on a regular basis understand that there is no guarantee that you'll get any kind of risk premium. You can go for 3 or 4 years with a negative risk premium. And that's what most investors who don't do this on a full-time basis, that's what they miss. They seem to think that markets behave more like a physical system, like a machine, rather than a biological system. And the sooner they can think more along the lines of an organic, dynamic kind of a ecosystem where sometimes you'll do well and sometimes you'll get eaten, you have to really understand those kind of market dynamics. The sooner they'll be able to develop more profitable investment strategies for wealth accumulation. And it's not even just wealth accumulation, it's really wealth preservation, because it's during those periods of market trauma where you are reacting emotionally that ultimately end up really hurting the investor. It's when the short-run markets don't allow you to be long-term investors.
Hey, Andrew, one last quick follow-up. You mentioned thinking about the economy as a machine. There's this great video, and I'm sure you've seen it, Ray Dalio walking through the economy as a machine on YouTube. Mm. And obviously, Ray's had tremendous success. I think perhaps the largest hedge fund. When you see that, are we misinterpreting him? Are we taking it wrong? How do you feel when you see that video where he's walking through everything as just a machine? Because it's very different than what you're writing about in adaptive markets.
It is, and I think that there are lots of different views on how markets work, and his is one, and certainly he's had some great success. But then you talk to somebody like Warren Buffett or to Jeff Bezos or Mark Zuckerberg, and they've each made tremendous fortunes in very, very different ways. And so I think what that tells us is that there are many different forms of success, just like when you look at the landscape of the African savanna, you see that you've got zebra and wildebeest and springbok and tigers and lions, and many different species end up coming up with different ways of surviving and thriving in a dynamic environment. I certainly don't doubt that Dalio has developed a very successful formula. The proof is in the pudding, and you can see that from their success. But there are also many other investors that have taken a very different approach and have become equally, if not even more successful. And I think it tells us that there's a richness to the market ecology that we have to appreciate. There's more than one way to skin a cat, and we really need to understand the various different kinds of species that are out there and how we fit into that ecosystem before we can develop a better idea about what our role might be and how we can maximize our chances for long-term survival.
I think people can feel that in our conversation today, and that's really what you've done in your book, is you're basically just opening up Pandora's box and saying, let's all think about this. Let's look at this three-dimensionally. Let's look at this from this perspective. Let's look at it from that perspective. Let's just be transparent about the discussion and try and put our egos checked at the door. I feel like that's where you've tried to go.
It is. And if I'm successful, I think people will actually develop a very different perspective about financial markets. I've written it in such a way that it doesn't require any prior knowledge of finance. It really is meant to capture people's imaginations. For those of us who really are steeped in markets, it will provide some interesting conclusions to many of the questions that were raised. But for others who don't have any experience, I'm hoping that it's going to give them a different view of how financial markets work and how they might think about making investments in that kind of a dynamic ecosystem.
The book, Adaptive Markets, Financial Evolution at the Speed of Thought. Andrew, is there a website that we can send people to check you out, send you a million emails? I don't know. Is there any place where you want to send people to?
There is my Twitter page. They can follow me on Twitter. I do have a research page at MIT, so they can certainly look for me online.
Very easily found. Hey, thank you for taking some time today. It only took me a couple years to track you down, but as I said, I'm quite pleased to finally get you.
Well, thank you very much. It's been a pleasure.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.